Hello everyone, welcome back to the Token Minds training series. Today, we are talking about receivables tokenization and how unpaid invoices can be transformed into blockchain native financial assets that unlock liquidity, reduce funding delays, and modernize how businesses manage cash flow. The objective here is turning idle invoices into working capital. So instead of waiting months for payment, companies can convert receivables into tradable digital instruments that connect directly to the capital markets. At the same time, programmable infrastructure automates underwriting, compliance, and settlement so private credit becomes faster, safer, and far more efficient to operate. Receivables are one of the largest financial assets most companies own, yet they remain locked in payment cycles that slow growth. Operations continue, suppliers must be paid, and expansion opportunities wait while cash is tied up in outstanding invoices. Tokenization changes this dynamic by turning future cash flow into immediate liquidity through blockchain based financial rails. So, at this stage, receivables move from simple assets into a fully automated capital structure. The system applies smart contract logic to define how risk and return are distributed across investors using a trends based model. First, the pool contract creates a senior and junior tranche structure. The senior tranche is designed to protect capital, while the junior tranche absorbs first losses and earns higher yield. This structure is not managed by legal agreements or spreadsheets, but by executable code that enforces outcomes automatically. Next, loss waterfall logic is embedded directly into the contract. When a default or shortfall occurs, the system checks the pool state on chain. If losses exist, the contract first deducts from the junior transit balance. Only when the junior trans is fully depleted does the contract route losses to the senior trans. This removes discretionary decisions and ensures every outcome follows predefined financial rules. Then, governance controls are layered on top of the risk engine. Transparencies such as allocation ratios, yield spreads, and reserve buffers are updated only through multi-signature execution and on-chain voting. Any structural change is time locked before activation, preventing sudden risk profile shifts and giving all participants full visibility. So finally, every capital movement is fully auditable. Each loss event, yield distribution, and governance action is written on chain. So this allows risk allocation to become mechanical, transparent, and verifiable, replacing manual credit committees with deterministic financial logic that executes the same way every time. At an infrastructure level, everything starts with asset origination. Invoices remain in enterprise systems, but their cryptographic fingerprints are written on chain using HAE 256 hashing and IPFS storage. This makes any post issuance change immediately detectable, turning accounting entries into verifiable financial instruments. So once anchored, those assets become eligible for automated underwriting, pool participation, which allows businesses to transform operational data directly into programmable liquidity. Underwriting and compliance are enforced entirely by code. So smart contracts written in Solidity and Rust define the financial logic, including maturity, face value, interest rate, debtor in identity, and pool eligibility. Dedicated models manage assets registration, risk evaluation, and pool administration, so credit policy becomes system behavior instead of paperwork. So token standards such as ERC 3475 and ERC 3643 embed KYC, jurisdiction filters, transfer restrictions, and holding limits directly into the assets. So if an investor fails compliance, transfers automatically revert, ensuring regulatory rules are enforced at the protocol level. Risk management and settlement complete the automation loop. A programmable engine structure tranches so senior investors receive capital protection, while junior investors absorb initial losses. Governance is handled through multi-signature approvals and time lock upgrades, ensuring no unilateral changes to risk logic. So when payments arrive, oracles confirm the amount, contracts validated, and funds are distributed instantly across tranches. Platform fees are deducted automatically, turning settlement cycles that once took days into near real-time execution. So this model is already operating in production. Centrifuge connects SME invoices to on-chain pools that are used as collateral in MakerDAO's real-world assets vaults, reducing funding time from months to days. Huma Finance recognizes payment receivables from payroll flows, subscriptions, and remittances. enabling stablecoin liquidity against verified future cash flows. So these systems prove that receivables tokenization is not experimental, it is functioning financial infrastructure. So receivable tokenization is moving from early pilots into real financial infrastructure. Over the next few years, more lenders, fintech platforms, and banks will treat invoices not just as accounting entries, but as programmable financial assets that can move seamlessly across balance sheets and capital markets. Token Minds helps organizations turn these systems into production-ready platforms. We design institutional-grade smart contract architectures, embed compliance into every layer, and integrate deeply with ERP, treasury, and payment systems. So, thank you for watching. If you're ready to transform receivable into programmable financial assets and unlock working capital through blockchain-native infrastructure, reach out to Token Minds. We'd love to help you build production-ready tokenization solutions that deliver real liquidity and operational impact.